Finance Minister Enoch Godongwana will deliver the 2023-24 budget speech on Wednesday. This comes at a time when the country is facing a turbulent economic outlook, high unemployment rates, and energy crisis, among a host of other challenges. We're now joined by Chief Economist at Econometrix, Dr. Azar Jammine, to preview his expectations, ahead of that budget delivery. Thank you very much, Dr. Jammine, for your time this morning. So, according to the Ministry of Finance, the budget allocation speech will aim to strike a balance between competing national spending priorities and the limited resources available to the national treasury. What do you read between those lines?
Essentially, the government is concerned that the bonanza that it has had over the last 2 years in the form of increased government revenue above what it expected due to high commodity prices, which boosted the profits of mining companies and through that boosted the amount of corporate tax revenue that was earned, that is not going to be sustained. Worse still, with intensified load shedding, the prospect is that economic growth is going to turn out to be quite a lot weaker than previously anticipated, further dampening potential government revenue. On the other side, the government has pressures to increase spending, firstly to fund an increase in the remuneration of public servants above what the virtually zero increase that has been given in the last year. Secondly, the government has committed to extending the social relief grant that was given originally for COVID-19. And thirdly, the government is aware that it has to increase introduce subsidies, and has stated it will intends to introduce subsidies of sorts for people to buy solar mechanisms to install into their homes to try and avoid lessen the impact of intensified load shedding. Now, where it's going to get that money from in the context of expecting to get less, not more government revenue, is the big challenge, and that is what I think the government is trying to hint at. It does speak to the probability that we will have yet another very austere budget, clamping down on areas of spending that are not seen to be absolutely essential.
Speaking of the government wage bill, Treasury forecasting a 3% per annum growth in the wage bill for the next 3 years. We're likely to see the employer and unions butting heads?
Absolutely. Well, that 3% was what was incorporated into the medium-term budget policy statement. Yet we learnt last week that in negotiations with public sector unions, what is on the table is 4.7% for this year, and CPI-related increases in the subsequent 2 years, which, if you look at the Reserve Bank's target of 4.5% for its longer-term inflation target, suggests that we are headed for pay increases in the public servant more in the region of 4.5% to 5% than 3%, and that would incur additional expenditure of somewhere between 25 and 30 billion rand extra per year.
When we talk about measures to make life a little bit easier for the everyday South African, what are you looking forward to the most?
There is very little that the government will do to make life easier for the average consumer. There has been talk about the fuel levy being reduced. We saw that temporarily for a couple of months. So we did have a temporary measure that was introduced in July and August to that end. But other than that, there's very little that the government can do. I suppose it can widen the VAT exemption net. There have been calls for it to exempt chicken, for example, from VAT to try and reduce the price of chicken to make it more affordable. That kind of thing, tampering with those kind of taxes is a possibility, but it's not entirely in government style to do so.
What about adjusting personal income tax brackets? And that has also been another suggestion when it comes to revenue collection. Is that something, is there room to wiggle?
In the past, the government has tended to adjust the income tax brackets upwards to cater for the impact of inflation in eroding people's after-tax income, because, if you don't adjust the tax brackets, their pay will increase and they'll move into a higher tax bracket and end up paying a higher rate of tax. The government has frequently acknowledged that the average tax rate in South Africa is already very, very high on individuals, and you've got a very highly skewed structure of taxation where only 2% of the population accounts for nearly 30% of all personal tax paid. There's a limit to which you can carry on milking that group of individuals.
Thank you very much to Dr. Azar Jammine, Chief Economist at Econometrix.